Hello and welcome to today's live webinar where we look at ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. In the last opportunities in review webinar, which we hosted in early November, the screenshot now picks up the attached spreadsheet which we send out as a link in the recording following today's live webinar. So this reviews the stocks that were covered as part of the high conviction ideas a month ago, and we'll look at these in a bit more detail when we get into the charts, but just to sort of summarize, so these were the US stocks up the top, and these were our overweight US positions which performed very well, especially in the case of Raytheon, Alphabet and Wells Fargo. On the ASX side, we had Amcor. We're bullish Amcor coming into the updated reporting result, and the stock rallied from $14 up to around $15.50, settled back around $15.20 at the moment. It also paid a 16-cent dividend over the last 4 weeks. We've been very bullish BHP on the thesis that we always saw that the resources would do better than the Australian banking sector, and as global equity markets were forecast to move higher, we saw a disproportionate flow of money coming into resources as a forecast, and that's really played out over the last month. So we're bullish BHP at 35, pushed up to around $38-39. Oz Minerals, we've been bullish on that. It's rallied from 9 up to 10.50. Woodside Petroleum, we were bullish at 31, pushed up to about 34. We're at $35. We'll review this, maybe $34. Ran into resistance. It's under sell conditions now, so it's been removed from model portfolios. Gold's really hasn't done much since we last visited sort of the opportunities within the gold space. But if you'd watched the top 50 recording, commented that you just had to be patient with gold because probably the fundamentals to push gold higher were just not in place short term. Transurban, we're bullish on this coming into the December dividend yield, so this is really an income line to portfolios. Transurban rallied from say 14.50 up to 15.50. It's still yet to go ex-dividend at the end of this month. Goodman Group rallied from 13.50 up to around 14.50, still sitting there. It's expensive, Goodman Group, but obviously it's growing earnings slightly above most of the other property trusts. GPT, our view here was own it, sell fairly tight covered call options, and still maintain that that's the case as a strategy there. GPT is only growing earnings about 2.5% now, so collecting the December dividend and stripping out added option income makes sense there. Coca-Cola, saw that as value at $10. It's rallied to $11.20, $11.30 thereabouts. Webjet rallied from $10 up to $12. We're out of that. We're not holding that anymore. A2 rallied from $11.75 to $14. We're out of that as well. A2 Milk switched to sell conditions just over the last week. On the ETF side of it, the Hack ETF, we've taken profit on that. India, we've taken profit on that. Asia, which gives you exposure to broad-based Asia tech, we've taken profit on that. QRE, which was a basket trade on Australian resources, we've taken profit there. And then likewise on the tech ETF, which is more of a US weighted large cap tech ETF, we've taken profit there as well. So again, just these are the notes from last month's webinar. Lendlease, still bullish on this. We think that that's undervalued growth. The stock price has performed very well over the last month. The banks ETF gives you broad-based exposure to all global banks. We've taken profit on that and we're on the sideline. If we see this switch to buy conditions in the early new year, I think that might be worth taking a look at. And we're still bullish CIMIC as a recovery play in the market. On the short side, Domino Pizzas, think that that's overvalued. Computer Share, still maintain that's overvalued. Crown, we've sold out of Crown, and it's fallen from around 13 back to around 12.50. CBA, very expensive relative to global banks, and we don't see CBA growing earnings, so we're concerned that that valuation premium that they're getting is not justified, and maybe fair value for CBA is back at sort of $77 rather than where it is at the moment, so on the short side of that. And Westpac fell from 29 down to $24 as part of that short strategy. Moving straight into the stocks that we want to cover today, I'm going to focus on the buy side of the market and the names that we're active in. So Sol Patterson's under buy conditions, but not really one that we're overweight at the moment. APA Group, we like this, so make a note of this one. This is a defensive yield, so what this requires is obviously US interest rates not to push higher. It's clear that global growth's struggling at the moment. S&P 500 earnings haven't really grown since September quarter 2018. Share buybacks are still a critical part of the market support and lower interest rates. APA, I think, at around sort of this $10.50 to $11 is a buying opportunity. Amcor, so this was one of our high conviction allocations, bounced off support at around $14, rallying up towards our target of $15.50. We think it sort of gets the full value there, and it's really then subject to does global growth start to pick up to drive Amcor higher. The attraction here with Amcor, which I've spoken a lot about, is the Bemis acquisition and the $160 million of cost synergies coming through from that. At $15.50, that's mostly reflected. If we look at the earnings update, about half of the earnings were coming through from cost cutting and the other half from underlying earnings growth. So the business itself's only growing at around 2 to 3%. So around 15.50 Amcor runs into resistance. Oz Minerals, so this whole basket of being long commodities, we've seen Oz run from sort of $9 up to around 11. The longer term attraction here with Oz Minerals is the expansion of their copper mine, which all things being equal, if copper prices stay where they are and the extra production comes online over the next few years, provides a big boost to earnings for Oz Minerals. So we continue to see this as a buy on the dip story. BHP, still bullish BHP. I'll speak sort of more generally about the index and the market, but BHP is still an overweight position for us. Medibank, no earnings growth here, but a defensive yield, and arguably owning it. Maybe it rallies up to $3.30. You'd want to sell covered calls over it. Rio, still bullish there on Rio, but BHP's our preference. Incitec pivot, maybe worth just making a note of this one. The short-term indicators are just starting to turn positive. The stock's corrected from $3.70 down to $3. It's under algorithm buy conditions, and we see that moving higher, and we've just started to add that into portfolios at the moment. Fortescue, preference BHP over that, not doing WiseTech. Telstra, so you're starting to see global portfolio managers increase their weighting to Asian telecommunication. So at the margin, Telstra, TPG are beneficiaries of that portfolio rotation, but the bulk of the money's going into the large telcos in Asia, and Australia makes up a small percentage of that allocation. But Telstra should be able to trade back up towards that $4 mark throughout the early part of next year. QBE and insurance. QBE would normally do well when global interest rates are moving higher, and with low levels of GDP growth, the probability of interest rates picking up seems pretty slim at the moment. So the attraction here with QBE is probably not so much the interest rate argument, it's more of a cost cutting and rationalisation of their insurance portfolio that may help to unlock value for shareholders. So support there in QBE at around $12. Transurban coming into the December dividend. This is expensive, as a lot of these yield or income stocks are. But Transurban has a pretty predictable 8 to 10% underlying growth in their dividend distribution, coming into the December dividend, owning it and selling covered calls and stripping out the income. Mirvac, I'd spoken that institutions had started shifting to a more bullish outlook to Mirvac. It's not a stock that I get particularly fond of, but just worth again just highlighting that the institutions continue to like the story there with Mirvac. AZJ, we'd been waiting for a pullback in this from $6 down to our target of 5.50. At that level, it switched to algo buy conditions, so we've started to allocate capital to AZJ. Defensive sort of income play for portfolio. We don't see it doing much other than maybe rallying back to sort of 580, 590 short term. ResMed continues to move higher. Goodman Group, terrific growth here, running at about 8% underlying EPS growth, but on trading less than a 3% dividend yield. There's limited upside, but well supported on the downside, I think. Magellan, under algo buy conditions here at around $45-50. It's one that I've commented on the blog, and we'll revisit the blog posts following this, and then finally sort of drill down to what our high conviction ideas are. REA Group, I think in an area where you're struggling to find companies growing earnings, you are paying a high PE for REA Group. It still looks attractive at around that 100 to 105 level. Northern Star, so all these gold stocks have had a significant correction. Northern Star's one that we're looking at, obviously Newcrest, Gold Roads, Evolution, so we'll come back and revisit the gold stocks in general, but Northern Star support down here at around this $8.59 level. Ramsay's starting to look a little bit expensive. We were buyers of it at lower levels. We've taken profit there in Ramsay. Downer EDI, so this gives you exposure to infrastructure spending, which Downer and CIMIC are obviously the leaders here in Australia. Downer's a little bit expensive, trading on about a 3.2-3.3% yield, growing earnings close to 10%, maybe sort of 7 to 10%. So any opportunity to pick up Downer on a pullback, I think you're positioning there in the right segment of the market. Now these regional banks have fallen almost 50%, or at least in the case here of Bank of Queensland, over the last 3 years. The question is, at what point do they start to become good value? But they're struggling to grow earnings, and cost of funding's rising. So at $7 or $7.50, there may be a short-term trade here in BOQ, and it advise probably just keep an eye on these short-term indicators and look for a bit of buying support to creep in there. There's value starting to emerge. Scentre Group, defensive yield, generating a little over 5.5% yield. The company's buying back their shares. Fairly low levels of earnings growth, but it is supported by the share buyback. I've had a target here of around $4, and we're selling covered calls to enhance the returns. Brambles, 5% underlying earnings growth, but it's hard to get it. Brambles trades on a very high PE, up over I think around 24 times earnings at the moment. The dividend yield's compressed under 3%, and it is dependent on global growth picking up or remaining at least where it is at present in order for it to support the high valuation. So be nice to buy Brambles below $12, but owning it here and selling slightly out of the money. Covered calls to drive the extra income also makes sense. Now, Star Entertainment, this has broken higher after sort of bottoming out at around 360. We've had the rally up to 480, and it's now pulled back to around $4.50. The company's been focused on a significant cost-cutting exercise from removing executive management, what they perceive as unnecessary staffing costs from the executive management side of the business, among other areas that they've stripped out. I think the number's something in the order of around $30 million that the company's identified as cost savings. But the market's going to be looking for evidence that the VIP gaming numbers are starting to pick up in the February earnings result, and I suspect they probably will do. So we're happy to look at adding Star back into portfolios at around this 450 level. In a soft market, we may see it down at sort of 430. So as identifying an entry range somewhere between sort of 430 and 460 should be an area that Star starts to find support, and it's now been added into portfolios following the switch from sell conditions to buy conditions there. Dexus, one I've commented on the blog. I just thought it was getting a little too cheap down here at 11.50, now pushing back up towards 12.20. JB Hi-Fi, this sort of defies my analysis, but one of the few companies where you're getting exposure to consumer spending, and JB Hi-Fi are executing well on their business strategy. We're happy to take a look at when in the mid part of the new year if we see a significant pullback there, but not doing it at the moment in JB. Cochlear's rallied off the $200 support level there. Coles, so this has pulled back from 16.50, and now I've identified this as a range. If we see it sub $15, you probably want to start having to think about adding Coles into portfolios. I think that offers some defensive income at around that, say 14.50, 14.75. GPT, if we go back 12 months ago, they were growing earnings sort of somewhere around 5 to 6%. We've seen that come back to around 2.5% earnings growth at the moment. You're getting large exposure to the office market, which still remains strong, but obviously there's concerns that if there was an economic downturn, that the office leasing is an area that'll be impacted. So the market is, I wouldn't say the market's pricing GPT too expensive at the moment. You're getting it on about a 4.5% dividend yield, and then selling out of the money covered call options, you're generating about 10% cash flow from the dividend and call option premium. And I think on a risk reward basis, that seems like an okay way of generating returns in portfolios at present. NIB Holdings, well, NIB Holdings, obviously health insurance, at around 670. It looks to me that the market's not really appreciating the defensive income opportunity here, with the stock trading on almost a 4% yield. Forecast earnings have just recently been reaffirmed from management at 5 to 6%. So coming into the February result, I'd expect to see NIB trade back above $7. So it's one that's we're confident on, and it's really starting to sort of move into our high conviction territory there. Westpac Banks correct from $40 down to $24 over the last 3 years. And we're all aware of the problems that the banking sector, and in particular Westpac's, faced over recent times. Whether the opportunity in the banking sector is to look at them at an individual level, or maybe through something like the MVB, which is the banking ETF on Australia, across the Australian banking sector, which picks up exposure in a, you're not going to exclude CBA from that basket, but you're going to get the regionals at a discount. So it's a matter of sort of weighing up whether you look at the banking sector from just 2 or 3 individual names, or that basket trade through the MVB. At the moment, sort of what stands out to me is maybe BOQ and NAB as the two that I'd be focusing on, avoiding Westpac for the moment. Coca-Cola, still see this as an attractive income opportunity for portfolios, owning it at around $11 and selling covered calls to enhance the return. Woolworths looking a bit expensive. If we were to see Woolworths back at around $35, we'll be willing to take a stronger allocation to that, not doing it there in AusNet. TPG, so Telstra is our preference, but TPG should be a beneficiary from that sector rotation that I spoke about earlier. ASX, we've seen this correct from almost 90 down to 79. It is expensive, but getting back to just over a 3% dividend yield, growing earnings at 5%. And it's a stock that should do well even if market volatility picks up, and you're seeing a lot of interest in mergers and consolidation within the sector globally. So we see the downside risk to ASX is relatively low, and this is a name that we've been buying, so it really comes onto our high conviction list as well. And NABs, I spoke about that within the banking sector. At around $25 looks to be maybe a little bit oversold. Insurance Australia Group, we like this, so should grow earnings at around 5 to 8%. We should see this push back over $8 into the February earnings result, and maybe up at around $8.25, $8.50 sell covered calls, but we like IAG. Bendigo, probably out of the regionals. I think BOQ's maybe the more attractive than Bendigo, but they've both been oversold. Lendlease, one of the better growth opportunities in the market, so buying this on a dip is attractive. The pullback's been fairly shallow from $20 down to $19. ANZ, there's a lot of commentary in the market around ANZ needing to raise further capital. Maybe for that reason, NAB and Bank of Queensland are the two, but I think it's debatable what the net benefit is of the individual names to, say, a basket trade through that MVB. That's something just to start having to think about, and I'll comment more on the blog around that as a strategy. Macquarie at 135. The company's guided towards flat earnings, so it's probably pretty close to the top end of the range there at the moment, and that was something that I highlighted, sort of between 135 and 140. We're original buyers of Macquarie at around 120, and that 135 to 140 is our target, so it's pretty close to that there at the moment. Orica's back onto the buy list here at the moment, so just keeping an eye on this at around 22.50, so you might just want to add that to your notes there. Atlas, not doing there at present. Cube Holdings, not really aggressive there on that one, not doing anything in Seek. CSL Flight Centre, so this might be worth just adding this one onto your watch list at around $43. I think it's back to sort of fair value. Sydney Airports goes ex-dividend later this month. The stock is relatively expensive, so trading on just over a 4% dividend yield. We've actually been buying this and selling the covered calls over it to enhance the income. Charter Hall, not doing there at present. Evolution, so within these gold spot stocks, they look like they're wanting to push just a little bit lower short term, but I suspect over the coming weeks you'll start to see a bottoming pattern start to develop across these gold names. So look for sort of a strong reversal in the open, high, low, close data, and I'll keep you updated sort of on the blog around that. So that's just a quick run through the stocks that are under buy conditions. What I wanted to do next is go into the watch list. We'll come down here and just review the recent signals on the ASX. So click on that. What this does is store the last 30 days of signals on the blog. Let's make sure we do that one. This one here, the ASX blog post. So what I'm going to do is get the percentage gains to the top, and then I'm also going to go over to the side here and organize them from in buy order. So what we're going to be doing is going through the stocks on the blog that are under buy conditions, and starting with APA Group. Now some of these I've already focused on, but this will just help to sort of highlight the names that we're shifting to an overweight position. So APA, that should be in portfolios. Amcor, we've largely missed the move in that if you're not already set, and you just want to maybe take a look at it at sub $15. Rio, we're still bullish the resource story, so we see upside there for Rio. We see upside for BHP. QBE, there's value there at around $12, so have a closer look at that. Telstra, the rotation globally into Asian technology, Asian telecommunication, I think that helps the sentiment around Telstra. Northern Star seems to be holding up better than the other gold stocks, so just highlighting that on a relative basis. Incitec Pivot, think about this at around 310, 315, starting to present value. Goodman Group, look, expensive but high quality property trust is the message there. Magellan, not really doing too much here in Magellan yet. We did own it as a trade. We've sub $50. We've got out of it at $52, just waiting to sort of see how strong the buying support and momentum builds there. Downer EDI, high quality infrastructure play, buy it on the dip. I think this is a high conviction opportunity, owning it here and holding on to it through the February earnings result. InvoCare, value starting to emerge at sub $13. If we have a look at it, it's had trouble really getting buying support over the last few months. Ran in a resistance at 14, and then it's tested 12.50. That's something just to have a small allocation in portfolios. REA Group delivering sort of reasonable growth relative to the rest of the market, but not a large portfolio allocation. Centre Group, good one to think about from an income line for portfolio at $4, sell covered calls. Brambles, 5% earnings growth, but the stock's rallied from sort of that 11.50 up to 12.50, so we're not seeing too much there in value. Keep Star on your watch list, somewhere between 4.30 and 4.50. It finds support, and just hold it into that February earnings result and look for better numbers coming through from VIP. Dexus, Coles sub $15, you want to buy that. Insurance Australia on the high conviction list, pushing back above 8.50 next year, or into the February result. I think ASX is value, so anywhere from 77 to 79, $80 should find support. Coca-Cola, good income line for portfolios. GPT, good income line for portfolios. NAB, I think I've spoken enough about the banks. Likewise with gold, or just to jump back to Newcrest, so somewhere between 28 and the next level down, 26.50. Gold appears to be getting oversold. Iluka is under sell conditions, so we're out of Iluka and just see it maybe running into resistance, so it's not really showing any evidence of rolling over yet, but it's one that I'll continue to look at on the short side. Domino's on the short side. CBA, you see these lower high patterns here, and CBA just seems expensive relative to the other bank stocks, not only in Australia but globally as well. Computershare, we think that has structural issues with earnings growth that'll play out over the next couple of years. Altium, this was a growth technology stock, ran in a resistance switch to sell conditions. So if we backtrack here, it had been under buy conditions from around $20, and now it's 36, it's gone to sell, so just worth drawing your attention to that. Boral's been under sell conditions, so it's had this series of lower highs. The most recent algo sell signal there at $5, pushing down to $4.50, and there appears to be increasing sort of issues around both accounting and just general earnings growth from that Headwater acquisition they did in the US. And the numbers in Australia are solid, but not enough to offset those problems in the US. So watch this over the coming months and just see if the market gets a bit negative on it and a buying opportunity presents early in the new year. And then there we are, back to APA. Alright, so what I wanted to do just to finish on today, we'll have a look at a couple of these US stocks that have done very well. So this year we've been running broking accounts through Interactive Broker, which gives us exposure to all the global markets, and the strategy's really been to focus on picking the best opportunities within the ASX 100 model and the US 100 model. So looking at stocks predominantly that are under algorithm buy conditions and supported by fundamental events. So in the case of Raytheon, which is a large US military defense provider, we've been attracted to this because of the merger next year with United Technologies. The company will be conducting a large share buyback program post the merger. There'll be cost synergies from the merger, and there'll be new IP that'll be generated from the combined groups. We originally started buying into Raytheon at around this 175, 180 level. We've been using derivative strategies to kind of amplify those returns through buying call options or doing spread trades within the derivative market, which just maximizes the returns over a shorter period of time. But always being supported by a fundamental story there that we like. So Raytheon's been one of the better performing stocks in 2019 within our international portfolio. Another one that we've been overweight's been Wells Fargo. Not very often would we take positions that are counter to the algorithm model, but the argument here for Wells Fargo was that the company was running a very large share buyback program, with the bulk of that, or maybe not the bulk, the highest level of activity of that buyback program was scheduled to occur in the December quarter. So we've been leveraged to that exposure, and that's worked out very well. So Wells is, when you think about sort of how the Australian banks have performed, whereas Wells Fargo's rallied from 45 up to $54. We've also been part of the recovery play in GE. So if we have a look at this, switched to, after being in sell conditions throughout 17, 18, and then we started to see a new structure begin to develop here, and it switched to buy conditions. So we've been long GE, and it looks to me that you're probably going to see support develop there again at around that $10 level, and it may have another push higher. So we're still on the long side of GE. AMD we've traded out of, which is Advanced Micro Devices. So this is a chip maker that competes with Intel, for example. So this algo buy signal here, we shifted to an overweight derivative exposure there, and that captured a large percentage of that gain there in AMD. Domestically this year, Telstra's been one of our overweight positions, so we did well out of the recovery in Telstra this year. And so if you're interested in the interactive broker account model, I'll just bring up on screen. So this is the structure of the account. It's based on a management fee. The brokerage is done at our cost price. We're incentivized through delivering performance over and above the market, and the broking account remains in your name. I work as your advisor, work in partnership with you to match your account to the ideas, the high conviction ideas. Quite often we have an underlying view in the portfolio where we're staying exposed to stocks for a longer period of time, and then just using derivatives from a shorter term perspective to take advantage of movements in the market. But it's a combination of the algo signals combined with fundamental analysis, looking at which companies are doing large scale share buybacks and to deliver those returns. So if you'd like to register your interest in setting up an IB account, if you go to our website, and I'll just bring this into screen. If you go to our website, click on online broking, click on register your interest, and it takes you through to this form. You can just fill in, depending on whether you're interested in opening an account in your super fund or an individual name, go through, fill that information out, hit submit. That comes back to us. We'll complete the paperwork for you and send it to you in the mail for you to review. If you want to just have a chat with me before you do that, then obviously just call me on 1300 614 002. To conclude today, I'm just going to bring the notes into screen and see what so this here is the notes that, again, these will be sent out with the copy of today's recording, so look for the link in that recording email. The notes from last month's are on the tab there, and these are the new notes. So where are we? Well, still in the US. We like Raytheon, we like Alphabet, so that was another name that contributed good returns in the last quarter. Wells we continue to like. So McDonald's and Starbucks are two signals that we've had where the stock hasn't really moved too much, but these are increasingly looking good value as a way of sort of driving low risk money out of the market. American Express is our most overweight position at the moment in the US model or US portfolio, and we've seen that start to push up from sort of 115 back up towards 120 as one of the better performing stocks in the market Friday night. If we look at the ASX, what do we like? IPL, I've spoken about that. Sydney Airports, not much growth, but dividend and call option income. Dow, which is Downer EDI, Infrastructure Opportunity, NIB, I've overweight that. SGR starting to sort of come onto our radar. I'm beginning to build position in that. IAG, overweight that, and high conviction. I'll mark these as high conviction before we send this out. APA, we like that, see opportunity there just because we think interest rates stay low. Lend-Lease still offers growth, but a lot of that's already priced in. AZJ at 550, we thought that started to look okay. Telstra over TPG, but both of those I've just flagged there. Medibank as yield support, I've already covered that, so we'll remove that. Coca-Cola, owning it and selling calls. On the ETF side of it, iShares South Korea ETF has been triggered as a buy signal, so take a look at that. Just broad exposure to the Australian property, just on this basis that interest rates stay low. So the SLF, which is the Spider property ETF for the ASX, I think that remains well supported. MVB's the exposure to the banking basket, have a think about that. CIMIC, increasingly these accounting irregularities that they were called out on, the stock's fallen from 50 down to $33. That's priced in, and the longer term thematic for the infrastructure play here in Australia underpins CIMIC, so I'd expect to see that recover over the next 1 to 2 years. Thank you for listening in, and if you'd like to have a chat about either the subscription to the technology that I used today or setting up an interactive broking account with us, please call me 1300 614 002.